All right, well, let the bullish run continue. It supposes this morning, as we're taking a look at the U.S. futures, point to a positive start. As we were just mentioning, we got inflation numbers in the United States where the reaction seems to be to focus on a slightly lower reading for headline inflation. Now, some goods inflation has been ticking higher. Some services inflation has been increasing. Nevertheless, traders had recently been ramping up bets for Fed interest rate cuts this year, and there's a quick takeaway that the Fed could be able to cut interest rates by 25 basis points as soon as September. Let's bring in Philip Petursson, who's Chief Investment Strategist at IG Wealth Management, to talk a little bit more about the market reaction and what it says about the mood of the market, which I think is trying to continue to will its way higher right now. What do you think?
Yeah, I think that's exactly it. The market almost seems benign to what's going on with the tariffs. It's not pricing in any tariff risk, and any good news just helps propel the markets higher. Any bad news really doesn't drive the market lower. It's just, well, that's what we expected. So it's kind of interesting that the overwhelming momentum is to the upside. The sentiment is to the upside, and it's almost as if nothing is going to slow this market down.
Okay, so how would you as an investor be reacting to kind of this momentum for stocks, all-time highs, pretty much in range right now? We're heading into kind of a season that notoriously is weaker for equities, but now you've got this potential catalyst of the Fed cutting interest rates in September.
Exactly, and there's a couple things there. One, you're absolutely right that September on average is the weakest month of the year. You have a higher probability of a negative return than a positive return for September, but that's a buying opportunity. So if we were to see any weakness in this market, we would take advantage of it. Second, with respect to the Fed, yes, we've got 90% probability, I think, being priced into the market right now that the Fed's going to cut in September. Some are saying they could cut by as much as 50. Regardless, we know the Fed is on the path to cut. When the Fed cuts, that's good for stocks. It's good for valuations. Valuations tend to move higher as the Fed cuts. With inflation today, doesn't seem to be that much of a worry. Now, we are likely to see perhaps a little bit of an uptick in inflation in the next quarter as the more permanent tariffs might start to bite. But based on what we've seen this past month, it doesn't seem that it's that meaningful of an impact that is going to perhaps derail the Fed from cutting or derail this market from moving higher.
Do you think, though, we can sort of make the firm conclusion that the shifting U.S. tariff policies have not created sort of a more complicated inflation picture? I only ask that because if you're going to nitpick here, like looking at something like the so-called supercore services measure, I think we saw the largest increase since January. It would seem to at least put a bit of a dent in the idea that tariffs don't have inflationary impacts.
True, but how much of the services inflation is actually coming from the tariffs versus coming from other factors, wage growth, I think being the key one. Despite what we saw in the labor market it was a couple weeks ago in the United States that was weaker, that might not actually be the case in terms of wage pressure. We continue to see wages up about 4.5%, and how much of that is actually feeding through into the services inflation versus a tariff that is more goods focused.
Yeah, and so against that backdrop, are you sort of against this idea of a worrisome stagflationary environment, which some people had been worried about, I think, especially coming into this inflation report and after a weak jobs report in the United States a couple of weeks ago?
Yeah, how long have we been talking about stagflation, though, right? It seems that this has been the one thing that economists have been throwing out there saying, well, just wait, here it comes, here it comes, here it comes. That's not showing up in the GDP data. If you look at Atlanta Fed now, it's tracking just below 3%. That's pretty decent growth. You have the consumer that's fairly healthy. Retail sales continue to increase at a modest pace, but at increase nonetheless. So I think stagflation is more of an explanation to justify positioning, but I don't think it's a reality as we go forward. I think we do have decent growth. We don't have stellar growth, but we have decent growth. The labor market, that is perhaps a little bit of a concern just with what we've seen. But there again, how accurate are the surveys? We're hearing that the survey response rate continues to drop. And so there's a lot of estimation in there that the consumer isn't necessarily reflecting a weaker labor market.
Okay, so for equity investors, you have now been looking at a very encouraging 3-year stretch. So the S&P 500 had back-to-back years of gains of more than 20%, and it's up now another 8% or so far in 2025 after the swings that we saw in April. The TSX, which is outperforming the S&P this year, is up in the neighborhood of 12%. Didn't have as strong as performance as the S&P in 2023 and 2024, but those were still up years, 8 and 18% respectively. So this has been a nice 3-year stretch, or 2.5-year stretch, I suppose, to be invested in equities. What do you think about in terms of your positioning in portfolios at this stage of the game?
Right. We've been increasing our weight to equities since April, since the lows of April, and looking for an opportunity in the fall to do so again. Strength begets strength. You know, people think that with a strong market, you're more likely to see a correction. That's actually not the case. You're less likely to see a correction than at any other time, but you're more likely to see an additional gain of 10% going forward over the next 6 or 12 months. So I think in this environment, let's focus on earnings growth. If earnings continues to come through, then that's going to propel the market higher. Valuation isn't as much of a concern as we mentioned earlier with the Fed cutting interest rates and with inflation stabilizing, I think around the 2.5% level. So this is an environment for investors to take advantage of volatility. Yes, buy the dip mentality has been solidified in this rally, but I think it's one that will reward investors over the long term.
Okay, Philip, good to get your perspective as always. Thanks a lot. Philip Petursson joining us, Chief Investment Strategist at IG Wealth Management. We're going to